Welcome to Lunar Capital's quarterly investment and performance review for the period ending 30th of September 2025. Please take note of our disclosures. Over the last 12 months, we can best describe it a period of two halves. Over the period, particularly in the first 6 months, we had to constantly remind ourselves of our investment philosophy, and that is to be owners of quality businesses with high growth potential and significant competitive advantages. Now, as a reminder, our process follows both a top-down and a bottom-up approach. At the top-down level, we develop investment themes by considering certain mega trends and the macroeconomic environment. From those investment themes, we identify a universe of companies that we would like to assess based on our valuation and assessment criteria. This then provides us with a short list of companies that meet these investment and ownership criteria that we would like to invest in. We then basically use that information to construct a portfolio based on certain asset allocation guidelines. In other words, how much do we want local, how much do we want offshore, how much in equities, in bonds, in cash, what sectors, and then ultimately, how much in each individual share or company, how much do we invest in that. Now, you must know that we have always been considered ourselves as basically investors in equities. So the question then is, why do we hold sometimes cash and bonds? And the reason for that is fundamentally to manage risk. So when we see a market, the equity market in particular, being overpriced, we then typically would invest some of the cash, or actually park some of the cash in bonds and in cash, waiting for better opportunities to invest. As long-term investors, we do want to be in growth sectors and taking advantage of companies that can continue to grow over the long term. Now, I want to take you first through the companies that we were invested in and which of them performed well and which of them didn't perform. And I've color-coded them, green showing those that have at least met or outperformed our benchmark of inflation plus 5%, and in red, those companies that didn't meet that criteria across the various themes that we are playing in. And you can see a bit of a mix, and definitely what you can see is that in two particular themes, which is technology innovations and the geopolitical valuation theme, those did incredibly well for us. And what didn't do well at all was in the diabetes, obesity, cancer theme that came through there. The others were a little bit mixed. Fortunately, those two sectors that did well really gave us the kind of returns that I'll take you through a little bit later in the presentation. Overall, we had approximately 70 to 75% in cash throughout the period, the largest being in US equities, second largest in South African equities of 19.4%, and then 9 and 8% in European equities and emerging markets excluding South Africa, and then the rest basically in cash and bonds. You can see those positions being fairly high. Now, if we look across sectors between the fund and our offshore portfolios, you can see a level of diversification, but definitely certain overweight, in the technology sector, which actually benefited us quite well, but also, in other sectors like financial investment management, in the retail sector, in the biotech space, in the energy space, and then obviously in fixed income and cash as well. So this graph basically shows you the top 10 holdings that we had in the Lunar BCI Worldwide Flexible Fund. Okay. So highest position was in the Vanguard short-term treasury ETF, which is basically sitting in cash in US dollars. JP Morgan was our largest holding at 5.11%, Berkshire Hathaway at 5%, Walmart, which we subsequently sold after the quarter end at 4.92%, Microsoft at 4.6%, Amazon and ASML at 4.5%, UBS, and then Naspers and Coronation. So this picture basically shows you our performance over the 9 years since we've been running the Lunar BCI Worldwide Flexible Fund. So you can see our performance is basically in the top quartile, or at least in the top 2 quartiles, over all of the periods that we show. What is particularly comforting for us is that we've continued over that period to beat our benchmark of inflation plus 5%. And remember that that figure is after our costs have been taken into account. We also like to look at how we've done against all portfolios that were available since we started our fund. And we actually are in the top 15% of all the funds that were available when we started the Lunar BCI Worldwide Flexible Fund on the 1st of June 2016. This performance was despite the fact that actually we had quite a bit in cash and bonds. Okay. So if you look at the performance, our performance against the market, the JSE did incredibly well, giving a return of almost 25% over the period. The S&P 500 16%, the MSCI Worldwide Index 15.3%. Interestingly, over a 1-year period, the USD ZAR rate was hardly changed, and the Lunar BCI Worldwide Fund gave a return of 14.82%. Very different to how it looked like 6 months ago, and that's why I started with the a year of 2 halves. Okay, so obviously a significant amount of return that we got over the last 6 months. Now, I want to take you through just what our outlook is, okay? And I really just wanted to focus on 2 kind of key themes, that we think are probably the biggest factors in the market at the moment. On AI, we basically view multiple layers of the AI ecosystem. On the infrastructure side, you have companies like NVIDIA, ASML, TSMC, Broadcom, Cisco, etc. So these are the companies that build the actual hardware or chips, or the infrastructure that is required, to have cloud centers or AI, AI cloud centers. Then the cloud centers, or what we call the hyperscalers, companies that actually set up that infrastructure using some of the products on the infrastructure side, and they on-sell that to clients that require those services: Microsoft, Google, Amazon, Oracle. And then companies that develop the models like Gemini from Google, DeepSeek, the Chinese model, OpenAI, which is really the one that is making the significant investments recently with a number of different companies. So those companies run the models, and then we look for those companies that use these models to do business, either improving the way that they do business, in other words, being more productive, or finding new drugs, or creating agents to assist individuals or teams, to run their businesses, well. That also includes, for example, robots. So we see that in the recent past, it was the infrastructure guys and the hyperscalers that have really done incredibly well. And we think to some extent there will still be some tailwinds behind that. But what we do see is that at the end of the day, the investments that they have been making will likely only pay off if there is significant usage. And what we're looking out for is where those that usage is going to be. That's what we're looking out for. The other area or theme that we are playing on is around high valuations, the trade wars, and interest rates. And in our view, we believe that the markets have been driven, by a large amount of inflows from passive investors. In other words, investors in ETFs that are driving out that are driving up the prices of the companies, particularly the big names in the indices, like the Nvidias, the Microsofts, and the Amazons. We think that trade wars haven't played out yet, and what we don't fully appreciate is what the impact on growth will be. Obviously, that depends on the outcome of the negotiations between the big players, and we've seen recently, the tit for tat taking place between the US and China. We think that what could provide some additional tailwinds is interest rate cuts in the US. And secondly, we think that in the short term, energy supply will be pretty good, but demand for energy will continue to grow, particularly for the requirements of the AI space. So in terms of our position, we see both risks and opportunities, and we are definitely taking certain positions in the AI space, what we would believe are undervalued businesses. We also like those businesses that can benefit at multiple levels. Okay, so for example, the hyperscalers like Microsoft can not only get benefit by selling those services to their clients, but they can also use AI to improve their business. And we've seen, for example, with both Microsoft as well as with Amazon, that they are replacing certain software developers with AI tools, particularly on the low end side of software development. Similarly, we see potential opportunities in use cases, in the drug discovery space, and also in the fintech space, particularly some of the newer companies coming out there, that are positioning themselves using AI natively. We believe those businesses could potentially benefit, quite significantly. On the energy side, at the long term, we think that nuclear energy will be the way to go, to be able to satisfy the demand required by these AI businesses. In uncertainty, we also often see opportunity. So, for example, gold has been a phenomenal performer, and certainly in certain emerging markets as well, that are taking advantage of the uncertainties, that are out there. We see some benefit in those markets as well. At the generational preferences and needs, we think that healthcare and wealth management will continue to be in demand. But importantly, for the younger generations, the Gen Zs and the millennials, digital services and values will be a big driver. And certainly those businesses that can provide, for this generation, we see them benefiting, particularly in the fintech space. So we also see fintech maturing given AI and better use cases coming through. So those are the areas that we are basically invested in. So just a reminder, that's our contact details. We have two products, which is the Lunar BCI Worldwide Flexible Fund. You can do it by debit order or a lump sum. And then we also have the direct offshore portfolio management service with a minimum of R500,000, that we manage on an individual basis for each of our clients. Why invest with us? Offshore exposure. We've got a track record of over 9 years. We have skin in the game. And I think importantly, we are not traders, and we think like investors. You're actually owners rather than investors. So invest like owners, of businesses. So, if we look at the portfolio of companies that we have, uh, we would, we are very proud that we are actually owners of those businesses. Thank you.